Welcome. This is the panel on the USA. We have a panel of experts here that's going to talk about strategies and pitfalls and overcoming challenges entering into the U.S. market. My name is David Rabinowitz. I'm co-chair of the Retail Consumer and Restaurant Group for Gulson & Stores. We're a law firm over 100 years old, based in Boston, D.C., and New York, and with an office in Beijing as well. We have a specialty in representing foreign retailers as they come into the United States and help them set up their business, not only from a real estate, but also from a tax and corporate perspective, as well as intellectual property and HR. I have a panel of experts here that are joining me. Welcome. To my immediate left is Ryan Patel. Ryan is Vice President of Global Real Estate and Business Development for Pinkberry, located in Los Angeles. Pinkberry is one of the fastest growing retail brands globally. Since commencing at Pinkberry in 2011, the company has gone from less than 95 locations to over 260 stores across 21 countries and is continuing to expand. Ryan is an expert in growing brands, and he's worked for publicly traded to private companies. Next to Ryan is David Skurlock, Design Principal at Callis in Architecture. He's from Seattle. We have the whole country covered, from the coast to the middle. Dave has over 25 years of retail design experience. He's one of the practice leaders for the global retail studio at Callison, one of the world's top architect and interior design firms. From their headquarters in Seattle, Dave leads national and international design projects, having worked with a diverse group of world-leading retailers and developers throughout Asia, the Middle East, the EU, and the United States. Next to Dave is Alan Shaw. Alan is the VP of Real Estate Leasing and Development for Sears Holding Corporation. Alan joined Sears in 2009 as their Vice President. Sears is the USA's third largest general merchandiser with approximately 2,000 full-line and specialty retail stores in the USA and Canada. Alan's responsible for bringing high-quality domestic and international retailers and brands into the greatly respected Sears Holdings retail portfolio. Alan is a 22-year veteran with real estate developers and entrepreneurs, and it's very timely having him here today because I think he's going to talk to us a little bit about his Primark deal. And lastly, but not least, is Nina Kampler. Sherry White from Vornado was supposed to be on our panel today, but unfortunately she had a death in the family and couldn't make it to the conference. So at 11 o'clock last night, I asked Nina if she could join the panel, and she graciously agreed to do so. Thank you. So Nina founded Kampler Advisory Group. She's a 30-year veteran as a retailer, lawyer, broker, restructuring advisor, and business expert. Nina formed Kampler Advisory Group in 2012 to provide opportunistic value to retailers and developers throughout the world. So thank you, Nina, for coming in at the last minute. There is a cocktail reception that follows in the room next to us, so when we're finished, if you want to go in there, that's fine. We're also going to try to leave time for question and answers at the end, but if you want to ask questions, we'll also take questions during our presentation. I'm going to start first just by spending a few minutes on a macro view of the U.S. economy. Right now, the economy is growing steadily in the United States. We've come out of the recession. And although our recovery is underwhelming when you compare it to other post-recession recoveries, relative to other advanced economies, we're actually doing quite well. Our GDP at the end of the third quarter expanded 3.5% at an annual rate. Business investment is growing steadily. Inflation is steady at 1.79% annualized. In October, we had our 9th straight month of job gains of more than 200,000 jobs. And unemployment in October fell to 5.8%, which is a 75-month low. One of the more interesting things, and it's having an impact on the consumers, is gas prices. In the United States, gas prices in many of our states have come down below $3 per gallon, which we haven't seen in a long time, and that really adds discretionary money to people to spend for discretionary items. On a little bit of a micro basis, one of our clients is Levin Management. Levin owns and operates open-air retail centers in the suburbs of New York, D.C., and Boston. So they're not in the urban centers, they're in the suburbs. And sometimes in the United States, it's a tale of two cities. You have the urban centers that are on fire, and then you have the suburbs that have taken a little bit longer to catch up. They do a retail survey every year at this time of year before the holidays, and they just finished their survey, and they talk to the store managers of their retail tenants. So you really get a bird's eye view of what's happening. And most of their tenants were very enthusiastic for the season that's coming in terms of growth. Year-to-date sales are at the same or higher levels for half of those who responded. 80% of the people who responded expect holiday sales to equal or surpass 2013. One-third will hire more seasonal staff than they did the prior 2 years, which is great. And 43% said that they would retain some seasonal staff as permanent employees, which is great for employment. So not only in the urban centers are you seeing growth, but also in the suburbs you're seeing growth. So overall, we're doing fairly well. So let's kick off the panel, and we're going to start with the submarkets across the United States. Which ones are on fire? Where are the places to go? And Alan and Nina are going to start the conversation.
Take it first. Thank you. In the U.S., there's New York City and there's everything else. What we find is that most of our locations, and again, let me preface this by saying I am here not only representing Sears, the retailer, but primarily Sears, the landlord. I joined Sears 6 years ago, which controls Sears and Kmart in the U.S. Over 2,000 locations, about 240 million square feet of retail space, which puts us one of the largest occupants of retail space in the world. And because most of our stores were built back in the 1950s, 60s, and 70s, when department stores were 300,000 square feet and larger, that's about 30,000 square meters. Today, you don't need a store that big. And so we're in the business today of downsizing, right-sizing, bringing in other retailers into our spaces. So I just want to make sure everybody understands my role here as a landlord. So the markets that are on fire for us are certainly the major cities in the U.S. I don't think it's any surprise. From the Northeast region, Boston down to Philadelphia, Miami, Dallas, Chicago, certainly the West Coast, California, Los Angeles. It's many of the cities that everyone would be familiar with. What you're finding, I think, is in the U.S., the better malls, shopping malls, are becoming that much stronger. There were many comments in the years past during the recession that the malls were dying, and in fact, you're seeing quite the opposite today. I'm not going to speak for Nina in New York City because we don't have many stores in the New York City area other than in the malls. But in the major markets around the country, again, the malls are thriving. The better malls are getting even stronger, and we're seeing continued strong growth in all sectors in those major markets.
You could look at submarkets either topically or geographically. Geographic, Alan's exactly right. You have the gateway cities, which are the cities you'd visit in the U.S. and the cities that you'd want to live in and send your kids to school in. New York obviously heads that. Within New York itself, there are specific submarkets, and the submarkets keep getting further divided. And it's interesting. I kind of think of New York City geography the way I think of, like, battling weight gain. It's like last year's high becomes this year's low. And so what you have in New York City is something insane. It's actually insane. I mean, when you think it can't get any higher, it gets higher. Just 3 years ago, you talked about rent in Times Square breaking the $2,000 barrier, and people were in shock. The new highest high in what's called Midtown, which is Fifth Avenue in the 50s, which is hotter than hot, not asking, but agreed to rent, has just broken the $4,000 barrier per square foot per annum. And this is fixed rent. This isn't the additional charges or the build out of the store. So New York City is hot. Within New York City, clearly Midtown leads the pack, probably closely followed by Times Square and then Soho. Topically, what are the submarkets are upper echelon versus outlet or value. I think post-2008, and David is exactly correct, in the last 6 years, we have seen now clear recovery. Unemployment is down to where it was in 2008, below 6%. You have gas prices low. You have additional labor force with approximately 200,000 new hires a month. That's been going on for a number of quarters in a row, and so that all results in extra pocket change. Notwithstanding that extra dispendable discretionary income, what 2008, 2009 has taught the consumer in the United States is to be value conscious. And so our submarkets are bifurcated. We have outlet and value, and we have luxury. Luxury is mostly high street in the gateway cities, but it is also, as Alan described, the top malls, what's known as the A centers, where there is flight to quality and compression, because everybody wants to be at the same spot, you know, down the block, down the door, down the path from Bloomingdale's, from Neiman Marcus. The outlets are what's really on fire. And so if I'll just share a quick statistic with you, over the last 6 to 8 years, we've had 50 new outlet developments in the United States. We've had 3 full-price regional malls. So the malls are oversaturated, over-retailed generically, though the top ones, there's still waiting lines to get in. The lesser ones, you could find space and there are deals to be had. The third tier you don't want to be in, but outlets are growing wildly. And outlets are in and of itself becoming a merged concept, because you have stores like H&M, same product, same price point, same merchandising plan, now going into outlets because there is a dearth of other malls that are right for them. And so the value mall is not only the Hugo Boss, the Theory, the Polo, the Coach, the Michael Kors at a certain percentage off of retail, but it is also value retail. That's what I see, David.
So let's spend a few more minutes on New York City. So New York City is comprised of Manhattan and then the outer boroughs. And there's one borough with a B called Brooklyn, which is really hot, not the Bronx. So can you spend a few minutes just talking about Brooklyn and what people are thinking in terms of Brooklyn?
Brooklyn's the 5th largest city in the United States. It's a city in and of itself. You know, when I graduated from law school, everybody wanted to live in Manhattan. My kids are graduating from college and from grad school, and they think that Manhattan is yesterday. They're all running to Brooklyn. So the neighborhoods that
I can attest to that. I have 3 daughters, and my 2 oldest daughters are now going to get apartments in Brooklyn. One in Brooklyn Heights, and the other in Bushwick, which is one of the up-and-coming areas of Brooklyn.
And so Brooklyn has retail in a number of places, obviously, but it goes beyond Brooklyn, David, if I may.
Sure.
Staten Island has many developments going on now as well. The first outlet center that's going to be happening within the 5 boroughs of Manhattan is actually with a spade in the ground right at the Staten Island Ferry, right over the other side of Manhattan. So you're looking back to downtown Manhattan, where there's excessive, fantastic development now with Brookfield and Westfield and what's going on at the Memorial and the former World Trade Center towers. And yet right across at the Staten Island Ferry, there will be a 330,000 square foot outlet center with an H&M, by the way. You have a hotel that's being developed, and you have a Ferris wheel going in, which will be 50% higher than the London Eye, really at the level of the Verrazano Bridge. So you, again, are borrowing elements of all of that, again, not just Brooklyn. It is expansion around the city.
Right. So why don't we move into retail real estate strategies that foreign companies use when they come to the United States, and you know, not just New York City, but also throughout the country. And with respect to New York City, because it's not just Manhattan anymore, it really makes it even more complex in terms of where a foreign retailer wants to set up, assuming they want to come to New York City first. So, so maybe Ryan and Dave, you could start the discussion.
So I guess I'm going to bring the West Coast bias a little bit more, since we're talking about New York.
We'll counter that a little bit.
Yeah,
We'll
cover that. Yeah. So, you know, I think there's 2 things. You know, for foreign, you know, or just retailers based not in the U.S., they're coming in. There's 2 methods of people I've seen retailers being successful or not. The one method has been, okay, I'm just going to open 1 store. I'm going to test it. I'm going to put it in Times Square, and let's see how it goes. Well, there's only a handful going to be successful with that kind of rents. I mean, I think that's where, testing a store in a high rent area, it's great for your brand, but in essence, I think everyone in this room can agree, everyone says, well, part of that rent is marketing. Well, that you can say that for so long. I think what we've been seeing, and then the retailers that have been successful, especially from Europe and even from Asia, has been, hey, let's look at this from a holistic point of view. Let's try to find a deal that makes sense for us and with our demographic. When you're looking at that perspective and you're looking at who is my core consumer in the US and do I have to change my retail offering or kind of source it a little bit differently, that kind of gives the brand a little more power, gets them a little bit easier to get in, gets their feet wet with that first store, and be able to kind of really get their cost of goods in line and as well as their product in line. So I think that has been kind of the macro level, and obviously from across the U.S. I mean, Alan said it best. I mean, the great malls around the U.S. are actually their comps are actually increasing. So when you look at footfall at the top tier malls in a lot of the major cities, it can be. So guess what? There's been, I think Nando's, that's probably familiar with a lot of people. They came into D.C. instead of any other market, and then now they're going to Chicago. I'm not using them as an example. I'm just saying they kind of avoided New York. They went that route, and they've kind of went slowly. And there's been other brands that have gone through maybe Chicago, and they went to L.A., or from L.A. to New York, and even from, retail and food. Even though I do have some retail background, but I do have a lot of food. In the U.S., it's both. For Pinkberry specifically, we follow retail. We live and breathe what retailers do. So that's kind of where I'm coming from that perspective.
Dave?
Yeah, I think very much, following what Ryan said, there's a highly evolved retail shopper and consumer market in the United States. So I think that when you're thinking about market entry, you really want to look for a kind of a comprehensive offering. And I think it doesn't matter if it's hard good, soft good, retail, fashion, food. I think you really want to understand your consumer. That's a great point, which you want to understand how to translate your brand, the attributes that you may have overseas, to a highly evolved consumer in the United States. And I think also we see a lot of success stories that come from people that understand the full breadth of, let's say, retail communication, which is online, web, celebrity endorsement. There's a lot of visibility issues that you need to address in the United States. I think there's one-off stores that's kind of that high market testing store, but we see a lot of retailers who are succeeding with a broader entry, but they're following the kind of roadmap of success, which is online presence, advertising and media, social awareness, social media, endorsement. I think all of those things are important to consider successful entry.
So our experiences, and if Sherry were here, not that I'm going to speak for Sherry, I can't and won't, but I think she would probably agree, is a lot of the European retailers and restaurateurs, when they come in, they start with New York City. And maybe that's a prior way, maybe an older way of doing it, but I think a lot are still doing that to try to establish a brand. And if you're going to establish a brand somewhere, New York City is a great place to do it. And if they're looking for additional locations, then the next strategy is, well, do you do a couple in New York City and then expand from there, where you do you do New York City, Miami, and either San Francisco or Chicago or Las Vegas? I mean, that's another approach too.
And
Go ahead.
Sorry, to follow up on that, it's no longer, to your point, you don't have to open in Times Square. I mean, you've got all these other cities inside Manhattan that you can kind of
That's
launch.
right.
And again, everybody says flagship stores. Those days of building oversized and build stores is no longer here if you can do it. But yeah, I mean, I think you can be able to do something like that, and the successful ones have done.
I think that there's a lot to be said for really understanding who your consumer is. If you're trying to go after a really, really high-end demographic, I think there's New York City, there's Las Vegas, there's some really high-end areas. But there are some great examples of other retailers who did not go into New York City. Primark, for example, is coming to the U.S. They're not going into New York City. They're looking at staying into the U.S. Shopping malls, which is where most Americans shop, versus the high streets of New York with the high rents. They want to be profitable in the U.S., and I think you can be a whole lot more profitable paying lower rents and being in some great locations around the country in the best shopping malls than you can developing a quote-unquote brand in New York City. Take Uniqlo, for example, who spent a ton of money opening up in New York City. I don't know if that store is ever going to be profitable. It's a beautiful store. I love their product, but they spent a lot of money. And they're spending a lot of money. I think it's one of the most expensive leases, David, you could probably comment on that, in the United States. And so could they have taken that same capital and deployed it elsewhere and opened up in many shopping malls across the U.S. where the average American consumer shops? The average American consumer shops at the mall nearest to where they live. That's because every mall in America has 90% of the same stores. So why would you travel downtown to go to a store that you can go to 10 minutes away from your house? So many of the retailers that we see looking to grow and expand are looking to expand in the shopping malls in the U.S. And of course, they want to be in the best shopping malls. Again, nothing against New York, but it's very, very expensive. And if you don't go big and have a lot of capital to spend, you put yourself at a lot of risk.
I think part of going into New York is the billboard effect. It's not just capturing the footsteps of the 52 million, yes, 52 million annual tourists, but it's the billboard effect.
And the 8 million residents.
And the 8 million residents, some of whom shop more than others. But the billboard effect cannot be discounted. And when you're taking space in Times Square, you're taking it not just because everybody's walking by. You're taking it because part of what you're looking for is the signage and looking for the billboard, and part of the rent is a marketing charge. And when you may be losing money on a per square foot basis, but without that, you then won't be able to achieve the same level of penetration in your branding that you're trying to accomplish as you're spreading out across the country.
As part of I think it's something to consider when you're thinking about a larger strategy of expanding, which is New York City. Fifth Avenue is really a tourist-driven market, and so it's rightly said that U.S. consumers, highly evolved, they're going to probably visit New York City, but it's largely a tourist-driven high street. You might really consider the after effect of that, which is you could run a flagship store in New York City, which is highly visible, and you get a lot of press, and you can test things, and you can stay in the media with that. But really, productivity is likely going to come from the shopping mall, and the higher, the competition of the middle and higher end shopping malls in the U.S. is extremely high right now because the comeback is real, and I think that's where you're seeing property development.
So two things. One, I think one thing Alan said, which is really very, very perceptive, and that is in our malls and shopping centers, 90% of the retailers are the same. And I think that's where the opportunity is for the European and Asian retailers and restaurateurs to come into the United States because it's something different. And I think every developer and property owner in the United States would love to have something different in their mall so they can differentiate themselves from other people and other mall owners. So I think that's one thing. The other thing is you're hearing two different philosophies. One is the malls, which is great, and the other is coming into the urban centers. I think you have a lot of urbanization occurring in the United States, I think around the world as well, but it's probably more recent in the United States, where a lot of the younger people are moving into the cities, not only New York City, but also other cities around the country. And that's why the urban retail is very, very important. But that said, you still have a lot of people in the suburbs and people raising their family in the suburbs, and that's why they go to the malls. So I think they're both great opportunities.
But the trend, if I may, is that it's greater urbanization than suburbanization, or as somebody aptly described it to me recently, we are experiencing the desuburbanization of the United States of America. And not only are people moving toward the cities, and is this the first time in history that more people are moving to the cities than the suburbs, but they're moving to the cities that are so expensive, and so their apartments are much smaller, whether they're renting them or buying them. And so there's basically two things they're doing there. One I won't say out loud, but the other one is that they're sleeping. Everything else they're doing outside of their apartment. They're working out, they're showering, they're eating, they're socializing. So that means that they are spending more hours of the day and more disposable income living their lives in the cities around them. That's why the developers and the shopping center owners and the real estate people are buying at 3 caps in order to have just a stake in the real estate in these great urban centers, because there's only 2 oceans. There's only one Chicago. There's only one New York. It's not going to go anywhere else. So unless, God forbid, the world is ending in front of us, that will continue.
I think another example, again, just to take some case studies, is one of the greatest retailers, in my opinion, is Forever 21. Forever 21 started out in strip shopping centers, okay? Not even in the malls, not on high streets. They don't spend any money on advertising. You don't see a Forever 21 billboard or television ad. Their strategy was to go into the shopping malls eventually. And That's where their bread and butter is. Do they have flagships in New York now and Chicago? Sure. But those came later. And their strategy was they want to be at the 50-yard line right in the middle of the mall, and that's where they're going to get the traffic. And they're going to sell by word of mouth because of their quality of product and because of their price points. And that's how they expanded. And I think they're still one of the greatest retailers that we've seen in the last 50 years in the United States.
Without even dress rehearsing this, we've just described the bifurcation that I alluded to. The luxury, where no matter what it is, they'll pay for it, and the value where people are, and the combination of the two.
I think the other thing that touches on is from a business strategy point of view, the United States is one of the markets that has probably the most highly evolved level of demographic data and customer information and property information. And I think what you see, even Forever 21 is a great example of somebody who really understands where they want to be and where they want to be in the mall and where their customer is, and they want to put their store right in the middle of that. And I think this is a huge key about understanding, we even led off that way, starting out and thinking about where your brand is, where your market position is, where your customer is, and then putting your store there, because I think those things are really greatly reduce impediments to success. Still, you're going to have to do everything right as a retailer.
And I completely agree. I think what you'll find is when you start looking at your market plan, and when I say market plan, you take a few markets and you kind of really go after the trade areas, and you kind of then compare markets to markets, you're going to learn something. We all have a lot of different opinions. You may find something, wow, this city is a lot better than I thought it was, or the spend is a lot higher than it was. And I think that is what, for your own brand, because you guys will know it the best, we'll be able to kind of connect to that market and go, okay, this is the best decision for our brand, because that's really where within your team, that analysis is really, really important.
Very good. Why don't we move on now to structuring the real estate deal? A little bit of comparison between the United States, different markets, and Europe. Alan, do you want to kick that off?
Sure. Other than California, most of the rents that you see are quoted on a price per square foot basis on an annual basis. California still does it by month. So when you hear
So I'll tell you a funny story on that.
Okay, go ahead.
At one of my former law firms, we were looking to open up a San Francisco office. We were based in New Jersey, actually, so on the other side of the country. And we heard that rents were really high. And we started getting the quotes back, and they were these per square foot numbers that seemed pretty low. And then we realized it was on a per month as opposed to an annual rent. So we learned that. Luckily,
yes.
we didn't sign the lease.
Yes. So just understand, is it per month, per year? Most terms are 10-year terms plus option periods in the United States now. In the better malls, they're not going to let you even break the 10 years unless you're going to pay a significant penalty. The taxes are pro rata. The utilities are pro rata based on the per square foot of your store. Inside the mall, you'll pay a common area maintenance cost. Some of the people who know from the deals that they've done with Sears, we include the common area maintenance because the anchors typically don't pay common area maintenance in these malls. So some of the mall owners don't like that because we have lower costs going in. So now if we're leasing out to other tenants, we have a lower cost compared to what they are charging in the mall, where they charge CAM, we don't. So there are those typical costs that you see across the board. I think the big difference, there's a company in the United States about 10 years ago or so, they're no longer around, called Steve & Barry's. Steve & Barry's had a model where they would take the tenant improvement allowance dollars that the malls and the shopping center owners gave them, and they would roll that into their operating profits into their stores, and it helped fund their growth of their business. Well, that finally caught up with them, and they're no longer around to speak about it. So what you're finding today, at least from our perspective, is that the landlords are not giving as high a tenant improvement allowance. In the case of our deals that we're doing as a landlord, we're not offering tenant improvement dollars at all, or I should say at a very rare occasion. We would rather have the tenants put in their own capital into the deals and keep the rents lower.
A couple of the things going on in the cities, especially with the omni-channel that's taken hold and is increasingly impactful, is getting away from all percentage rent calculations, which is kind of rendered moot and meaningless right now. I mean, how do you calculate sales based how do you calculate rent based on sales when you're buying online and returning in the brick and mortar? And so it's got to be more predictable, and everybody's got to run their pro formas, landlords and tenants alike. It's got to work, and so it's more of a fixed rent situation than perhaps 10 or 20 years ago.
But sometimes you see, Nina, especially with the non-U.S. retailers coming into the country, and it's not a proven concept. Sometimes, in order to make it work, the landlords will agree to a lower base rent and then have a percentage rent component for a certain period of time just to see how that works.
I guess if there's 1 or 2 or 3 stores in the country, that could work. But when you start to have a significant real estate presence, and you're also selling online and cataloging, and your store becomes showrooming, it becomes a little bit more complicated.
That's right. That's exactly right.
I also think that with the great desire to own real estate, retail real estate in the U.S., particularly in the gateway cities, as a retailer or a tenant going in, you need to really anticipate that the likelihood that the person you sign the lease with is going to be your landlord is increasingly slimmer and dimmer. And so the protections that you need from landlords and banks alike, especially if you're putting in your own money to do your build out, that's very significant. Those are a couple of new trends.
Yeah, and I'm sure Alan will agree to reimburse the tenant for their fit-up costs if there's some kind of default on the landlord's side, right?
Alan personally or Sears?
That's one of the things that we've really seen too in the work in design of retail stores and retail mall interiors is that the outfall of the omni-channel idea has really mostly gotten the attention of the mall developer. So store design needs to be sophisticated, mall tenant criteria are sophisticated. So I think this is one thing that we see, this is a changeover from years ago when the market was maybe less aggressive in that sense, is that store design matters and the mall experience matters, and you're going to see more challenges from the mall developer and the leasing agent about satisfying the criteria and providing a store design that meets their mall's expectations and your customer's expectations.
I think from our experience, one of the biggest differences between Europe and the United States in terms of the leasing is in some countries in Europe, there's an automatic renewal of your lease. So it can go on, I don't know if it's forever or some period of time based on some fair market value of rent. But in the United States, it's a term, and then you have to negotiate for renewal rights. And as Alan said, with most of the retailers, it's a 10-year term, but if you're dealing with a larger retailer, they'll negotiate for 15 or 20-year terms, like a Walmart or a Costco or something like that. And then you're lucky. In the suburbs, I think you're probably better being able to negotiate for renewal rights in malls. But in New York City, at least, landlords give you a very hard time for renewal rights. And that's because things change so quickly in New York, and 10 years is a long period of time. And after 10 years, they want to be able to have the flexibility to do what they want with their building and not be bound by a deal they cut 10 years ago. So you really have to fight very hard for those renewal rights. From the retailer's perspective, especially a foreign retailer coming into the United States that's investing a lot of money into a flagship store, they're really investing a lot of money, and it's only a 10-year term. It's really a very, very large investment to make, not knowing that you can have more renewal rights. So it's an important thing to consider when you're negotiating your leases.
And let me add one other point and give the lawyers a plug here, which I don't do too often, which is when you come into the U.S., you really want...
I'm taking some notes here.
Go ahead. You really want to make sure you have the best advisor. And someone who can not only negotiate a deal, but who knows the customs and the trends of what's reasonable, what's not reasonable in the U.S. I think that helps to have the deal go a lot smoother. You're getting a good direction and good advice, which will protect you long term.
And there are differences negotiating in New York City, in malls, in open-air centers. I mean, everyone is different in terms of what the custom and practice is. And then when market is, market does change over time, and it's really important to know what the market is.
And you need an exit strategy. I mean, I don't know what anybody in this room did when they got married, but if you were to get married today, you'd have it all written up ahead of time, right? So it's the same thing with your real estate deal, especially when there are
Nina, do you and your husband
rights.
have an exit strategy? I haven't heard
No,
of
we
that.
got married as kids, and he's afraid to leave me, so so we're still hanging out together. Very, Of course, I'm usually on the road, so that works really well. But The reality is that you need an exit strategy, and whether it's an assignment and sublet right that works for that jurisdiction and that property, whether it's figuring out ahead of time what the buyout is going to be and what improvements could be kept and not kept. I mean, you've got multi-floor stores now in Midtown Manhattan because the ground floor asking rents are too high, so you're going up. And you're spending $30 million to build this out. Do you really want to have to rip out the internal staircases? I mean, lots of little things. You need the exit strategy both financially and physically.
All right, we're going to get into that a little bit later, but also in terms of whether you sell your business or not, the last thing you want to do is have to go back to your landlord for consent. So we'll talk a little bit about that later. Why don't we move on to best strategies for expanding your brand into the United States? We covered some of it, but let's talk a little bit more about that. Ryan and Dave?
Well, I think Ryan and I touched on it a little bit, but I think this is one of the things where you really want to have a great understanding about how you're going to translate your brand and your attributes, especially for international. A strong international brand is maybe going to be landed in some country or some cultural thing. I think you need to think about a sophisticated consumer in the United States that will have more awareness now than ever about international trend, but may need to tune your brand statement or your mission or your message so that you're getting your target demographic, your target consumer, you're getting the message right.
So how do you do that? I mean, you're coming into a new country that doesn't know you. How do you do it?
Well, this is where I think that, this is the good thing about all this customer and consumer information that we have. I think that, as I've worked all over the world, you see some high points and some low points about what kind of consumer information and data and property data and, kind of the catchment area, the idea about who's really around the property that you're looking at. So I think this is really important to understand your message, have a good handle on where you are and your message and the type of customer you're looking for, and then be sure that the property that you're attracted to, which, could be high street or could be mall, is really going to get you to that customer. You need to be around the people that are going to make you successful.
Yeah, I mean, I think really is understanding your brand and not, understanding what your core competencies, your core mission statement is, and what you not to compromise on that. I mean, obviously you're going to make some compromises when you come to the U.S., but really identifying what those things are, and if you identify those things, then you won't get into this trouble of, well, am I going to dumb down the brand? Am I going to change the style? Am I going to do it a little bit more American? Because really, what's made any retail outside the U.S. unique is it's because they're international. And I think that is what, I don't think the U.S. consumer wants wants to go buy U.S. clothes from an international consumer. It's the other way around. I think the second piece, we kind of hear it, co-tenant. It's kind of similar what what international, when I look at international real estate and vice versa. Who's out there? What's the co-tenancy? What's the comparable sales to your competition, to other people in the industry? And also, we were talking about legal deals. If you find someone who's on your team or an attorney who's recently done a live deal with another brand that's similar, what do they get? I want to get what they have. You're really pushing, I'm a tenant, so I'm going to push a little bit more toward the landlords. It's like, this is what I want, and this is what I'm going to try to get. I'm not saying you're going to get all that, but at least you know what ideal looks like, and then you can kind of go after that, and and then we'll see where it lays out.
But part of the brand introduction is not only to the consumer, but also to the landlords. So I'm curious, we'll go on, finish Ryan, but then curious, Alan, how Primark got to you and how you got comfortable with them and how that worked in terms of that introduction.
You go first.
Okay, so a couple points. I'll talk about Primark in a second, but this past week I was with one of the largest Asian retailers, I won't say their name, looking to come into the U.S. And once they figure out the sizing for the American consumer in terms of apparel, which is important for the Europeans as well, although not as different than it is in Asia. What's most important, and what I suggested to them, to your point, was maintain your brand identity. Maintain your international flair. Don't try to be another U.S. retailer, and I think that's really important. So to your question, David, about how did Primark get to us, it was mutual. We were approaching them. They were working through a U.S. consultant, and so we kind of came together. The deal came together very, very quickly in about 9 months. It took from the time we had the first meeting to the time we signed the deal.
But how did you get comfortable with them?
You have to see their stores. They have to visit your spaces. They have to understand the market. You have to make sure that you're comfortable with the fact that they do understand the market and they're not going to overspend and get into trouble. We felt very comfortable with their management that they knew exactly what they were doing. They knew who they were. They knew they wanted to be in the U.S. and they had the strategy. And ultimately the capital to be able to put the deal together.
And I can attest to that with other landlords too, with the major ones with Westfield and Simon and GGP. You know, I'm going to say something nice about a landlord, so hopefully no one's recording this. But you know, they
Stop the recording right now.
You know, some of these top tier malls, they do kind of care what they want to have. I mean, you know, if it's a premium brand or it's not, it's like this is a unique offering. I don't want two of this. Now that doesn't happen very often, but in some of the best malls, they are trying to be picky. And I think you're really kind of, I hate to use the word selling, but you're really talking about, you're selling not just the brand, you're selling your team, you're selling what your strategy is. They don't want to know what okay, you just want to do one store. They want to know what your plan is for the whole U.S. You're actually pitching them like they're an investor. And I think when it kind of becomes a partnership, and at the end of the day, that's how these deals to get in, to your point, how do you get into it?
I think that's a great approach in terms of like an investor. One of our clients is Exki, and Exki opened their first restaurant in Manhattan in the United States over the summer, and they're fitting up their second one. And we were doing a lease with it was in New York City, a family-owned real estate company that had been in New York for many, many years, and they're used to doing things their own way. And we got down to some pretty critical issues at the end because Exki was used to doing it the Belgium and European way. And we had actually a face-to-face meeting, which is pretty unusual now in New York City to actually have face-to-face negotiations. And Exki has 3 founders. One of the founders was in New York, and we went to the meeting. We spent more time prepping for that meeting, focusing on him explaining the concept and how they founded the company and what their vision is and what their success is in Europe and what their vision is in the United States and why they're different than others than we did on the 10 legal issues and business issues we had to get over. And these landlords, they were just blown away by the presentation, and it was really, really critical, I think, to establishing credibility with this landlord. Why don't we talk now about operational and legal pitfalls in doing deals in the United States?
David, tell us about the operational and legal pitfalls.
Well, actually, first, Ryan, Dave, do you want to start first on the operational, and I'll pick up the legal side?
Well, I think a lot of the things that we see as store designers is success stories that are going to come from people who have put in the research and the thought about all of the small things. I think all the details about logistics and operations and finance, how you're going to structure your business. We've seen not only businesses coming to the U.S., but then foreign businesses that we're taking to other countries as well. It's hugely important to understand the business and tax ramifications of things so that your operation starts from the ground up, I think, on a strong footing. And that's going to come from delivery and stocking and employee. There's huge employee issues and labor issues between Europe and the U.S. or between Asia and the U.S. So I think that all those are considerations. I'm sure you've been through that.
I'm shaking my head because there's some horror stories too.
Yeah. So I think there's a lot of the small details. I think we've talked a lot about brand and design and negotiating things, but then there's a bunch of this lower level things, which is just the general opening your doors and doing business that all needs to be lined up before you're entering into a lease or planning construction.
Right. So we're working with foreign retailers, non-U.S. retailers, but also domestic retailers. But more specifically with the non-U.S. retailers, the United States is a great place to do business in. It's capitalism, maybe not at its best, but it's pretty good. But there are a lot of rules and regulations, and we're a pretty litigious country. Which has its good points, but its bad points. So what we try to advise our clients is ways of mitigating those damages. So HR, human resource, is an example for that. And you can get sued for anything in the United States, and someone can claim a sexual harassment or an age discrimination case, and you're really exposed. And one of the ways of mitigating against that is by having an employee manual set up and have your managers trained and have your employees trained. And having systems set up in order to again make sure that if a claim is brought, you've done everything reasonable in order to train your people to be able to defend that claim. And we also have a risk management group that actually advises clients on the type of insurance they have and how to mitigate their risks so that they're able to be successful. So these are challenges and they're hurdles, but they're definitely surmountable if you put some time and thought into them. The other thing we do on the entity side is try to protect the foreign parent from liability in the United States. And we do that by setting up LLC or limited liability companies that are U.S.-based companies and not have the parent involved in the transaction directly. So that creates some problems because when you're doing the leases, and I'm sure Alan's been through this, you want to know who your tenant is from the landlord's perspective, and you want to know that the tenant has some wherewithal to back up their obligations. So you get into negotiations on an adequate security deposit and also guarantees. And again, by creating a U.S. holding company that will act as the guarantor that has some assets, that's one way of at least protecting the parent. There's also two schools of thoughts. If you're going to open multiple retail stores in the country, whether you have the same tenant entity on each lease or do you set up a different entity for each lease. So if you have the same one for all your leases and you have 100 leases, you're exposed because you have a lot of assets. If you do a different tenant for each lease, then that liability is constrained to that one tenant. At some point, it becomes an administrative nightmare to have too many LLCs, but that's also another way of doing it. In terms of security deposits, oftentimes they're either cash or letters of credit. Therefore, and again, it depends upon what the backing is in terms of a guarantee, 3 to 6 months of rent. Sometimes there's a burn down provision so that if you're a good tenant and you pay your rent after a year or 2 years, it burns down. So if it starts at 6 months, it goes down to 3 months. And landlords prefer letters of credit as opposed to cash, which is counterintuitive. You would think cash would be better. But if there's a bankruptcy situation, the landlords are better protected with a letter of credit. We've had issues with letters of credit with the U.S. banks and the European banks. And I guess my advice is really, before it gets to the point where you actually have to have the letter of credit issued, to make sure that your two banks are talking. Sometimes it's the same bank with branches in the United States, and that makes it easier. Oftentimes it's not, though. So that's really important to avoid a last-minute problem with a letter of credit, and it also doesn't speak well in terms of your credibility.
I think when we think about these issues too, I think operationally and legally, I think the challenges that go between operating, coming to the U.S. or going to Canada or going to Mexico, these are all three completely different scenarios. And so even for our firm, which does work with retailers from the U.S. that go to Canada even, this is the same kind of thing, where all of these same issues come up legally, operationally, especially with labor relations, completely different. So I think you really want to understand all those issues before you plan for an expansion.
Right. There's also something that's really specific to New York City. It's called a good guy guarantee, which is a concept that really doesn't appear in other parts of the country. At least I don't know, and I don't think it's in Europe because I know I've had to explain this a number of times to my foreign clients. And what a good guy guarantee basically says is, let's say it's a 10-year term lease, and let's say the store isn't doing well, and the tenant wants to close the store up. So after 2 years. So the tenant would be in violation of the lease, and the tenant under the lease is technically responsible for rent for the balance of the term unless the landlord leases it out. And in New York, at least, the landlord has no obligation to go lease it out, although they probably will. What a good guy guarantee says is that the guarantor guarantees the rent up until the time that the tenant vacates. So if they vacate after 2 years, they guarantee the rent up to 2 years. And more importantly, from the landlord's perspective, is they guarantee that the lease is going to be turned over and the premises are going to be in the condition required under the lease, so that there's not going to be ransacking and damage done to the premises. So it's really, from a tenant's point of view, it's actually pretty good because it's a limited exposure. The landlord gets some comfort from it, but at the end of the day, you still need something in terms of the security deposit in order to back it up. There's also data and privacy issues. There's laws in the United States that prevent you from taking too much data from customers at the point of purchase, and you have to be aware of those laws so you can make sure you train your employees properly and you don't get exposed. Construction is very, very difficult, especially in New York City. Typically, the landlord turns over the property, and the tenant's responsible for what it takes in order to get permitted to open your premises. And there's old buildings in New York, maybe not as old as in Europe, but fairly old, and you don't know what's under there until you start actually fitting up, and you run into problems and issues, and it's very important to have expediters that can help expedite the permits and very good construction people on the ground. And then exit strategies, which is what Nina was alluding to. When you negotiate the lease, typically the landlord have rights of consent if you want to transfer the lease to somebody else. So if your store's not doing well and you want to get out of your lease, one way of doing it is assigning it to somebody else that wants to take over. The landlord has some say in that because they want to make sure that tenant can pay the rent, so there's a consent right. which is pretty standard. You try to get a reasonable consent right, and that's usually negotiated. But what you want to protect yourself is if your business is successful and you sell your company, or you go public, or you do something that's a capital type of transaction as opposed to just a one-off store, you want to be able to make sure that you can do that under your lease without the landlord's consent. Because the last thing you want to do is go back to your landlord if you want to sell your business. It's really not the landlord's business to get involved in that. And that's something that if you don't negotiate the lease properly, you'll have to go back to each landlord and get their consent to that. Anything else on that? Okay, so why don't we do some takeaways now? Want to start, Nina?
Global economy, great opportunity in the U.S., the epicenter of consumerism. At both ends of the spectrum, people are buying, and they're buying more than ever. And notwithstanding that it seems that everybody's buying online, the hard facts say that, depending on which statistics you read, anywhere from 94 to 90% of sales are still taking place in stores. So online is anywhere from 6 to 10% across all categories, amalgamated. So retail real estate is extremely opportunistic, and we'd love to have more fabulous brands in the United States.
I guess my biggest takeaway or suggestion would be to focus on how much you really want to invest in the U.S. If you have millions and millions of dollars to invest and you really want to establish a brand and it's high-end, New York, I think, is the right place to be. If you want to follow Forever 21 and what Primark is doing and appeal to the masses in the U.S. and the Americans where they shop, it's in the malls. And I think the malls, you'll get a little more bang for your buck. You'll get the support of the mall owners. You get the traffic of the malls. There's a lot to be said for the malls in the U.S., the good malls in the U.S. And so I think that is probably the biggest takeaway is where do you want to be? Do your research. There have been a lot of failed European retailers, and you know who they are. And what the mistakes were that they made in coming to the U.S., thinking that they understood the U.S. consumer. And I think they found it a little more challenging. What I think you're hearing from the panelists up here today is do your homework, but also know who you are. Maintain your brand. Don't try to become Americanized, and make sure you have the right advisors to be coaching you along the way.
I think as a designer, I think following right on what Alan said, I think the success stories that we see as designers are people that are coming to, brands that are coming to the United States with a clear strategy, who've taken advantage of planning and resources, informational resources that are available to them to make a clear strategy about how they're going to enter the market, how they're going to expand inside the market. I think we see less success with people that don't take for don't see the market as what it is, which is pretty dense. There's a lot of coverage in most of the major categories. I think there's still lots of room, lots of opportunity for unique offerings, but I think people that are successful are taking advantage of planning and organization and strategy things that help them be successful.
And not to echo all that, but I think that the other thing to add to all this is, not just to do your homework, but to connect with other retailers, to connect with other people in the industry, because you can learn a lot. I know I've learned a lot when I've gone internationally, and the international retailers have helped my concept out. So we do the same thing when you guys come in this way. So I think that perspective of sharing information also provides confidence. And in the U.S., there was a lot of opportunity. There's a lot of different shopping centers, from malls, lifestyle centers, street, you name it, we have it. And how you want to launch, there's multiple entry points that you can do, and it's up to you guys to do that.
So I guess I'm going to talk about Exkey again for a couple minutes because I think they did it the right way. They studied the U.S. market for a couple years before they decided to come in to make sure it worked, to do their demographics, to do their pro formas. And then when they came in, before they did actually, they established a team, a really good team, where they teamed up their European professionals with the newly hired U.S. team. So they had their European chef coordinate with the U.S. chef that they hired, so that there would be a coordination of the menu items. Of course, it has to be a little bit different because it's the United States, but still some consistency among the brand. They had the European architect and the U.S. architect talk to each other so that there, again, be consistent in terms of the store, the way the stores looked. They had their HR people come over and also talk with the counterparts in the United States. And I think doing your homework and then getting the right team, not only your European team, but the United States, is critical. So your HR team, the real estate brokers you're going to use are absolutely critical. Your retail consultants and your architects and interior designers and also your contractors. I mean, they're critical to have a contractor that really you can rely on that's going to get it done. I'll say this, although it never happens, at budget and on time. And also the legal advice is very important. So I think with all that put into place and doing your homework and being willing to spend a little bit more money at the beginning to make sure that you're mitigating your risks and you're setting up your companies right and you're protecting yourself, I think really will pay dividends as you're successful going forward. It's easy to do it now. It's going to be more difficult to correct it when you make the mistake and then something happens later on.